Welcome back to FinScribble. If your portfolio took a sudden beating recently, you are definitely not alone. When the Dow Jones cratered over 1,100 points in a single session, it served as a brutal reminder of market volatility. Today, we are diving straight into why August has earned such a notorious reputation as the stock market's most cursed month. Is it just a string of pure bad luck? Or is there a genuine structural reason why asset prices get chewed up right before autumn arrives? As everyday retail investors, watching your hard-earned savings plunge in real time can feel deeply unsettling. But panicking is the single worst move you can make right now. Over the next few minutes, we are going to break down historical performance data, expose the structural liquidity traps, review fresh economic outlooks, and equip you with a smart defensive game plan to navigate the rest of 2026 smoothly. When we examine decades of S&P 500 historical data, August consistently ranks among the weakest calendar months for equity returns. While spring often brings optimistic capital inflows, late summer historically delivers flat or negative average performance, accompanied by sharp volatility spikes. Statistical charts reveal that over the past century, August and September frequently battle for the title of worst performing month of the year. It is not just your imagination. Major stock indices experience noticeably higher frequency of sudden dips during this specific late summer window. Jordan might look at this historical trend and assume the stock market is somehow rigged to collapse every single August. However, Maya recognizes that seasonal patterns are probability distributions rather than guaranteed destiny. Understanding this distinction prevents you from making emotional decisions driven by scare headlines. Instead of viewing August as a guaranteed crash, smart investors analyze the underlying mechanics driving this historical phenomenon. So, why does this volatility happen every late summer? Enter the skeleton crew effect. Imagine a giant public water park on a hot July afternoon. When hundreds of people are swimming, a single person jumping into the water barely creates a ripple. But in August, main institutional traders, hedge fund managers, and senior market makers take vacation. Now imagine that same water park with only 3 people left in the pool. If someone jumps in now, that exact same leap creates a massive splash that rocks the entire pool. That is precisely what happens on Wall Street. Trading volume drops significantly because the big players are away from their desks. With fewer orders absorbing buy and sell trades, market liquidity dries up rapidly. As a result, routine headlines or automated algorithmic trades trigger massive, exaggerated price swings that look far more terrifying than they actually are in reality. Looking past seasonal summer noise requires focusing on fundamental valuation. Independent analysis from Morningstar for the second half of 2026 suggests that long-term market fundamentals remain surprisingly resilient despite temporary sentiment shocks. Morningstar valuation metrics indicate that while mega-cap tech stocks experienced valuation stretch earlier this year, broader market segments, like dividend-paying stocks and value equities, are trading near fair value. Jordan sees a one-day 1,100-point Dow drop and assumes the entire macroeconomy is breaking down. However, Morningstar highlights that underlying earnings growth, corporate balance sheets, and stabilizing inflation trends support long-term economic expansion. Seasonal illiquidity in August creates artificial discounts on quality businesses. When short-term traders panic over thin volume noise, disciplined investors can look at second-half projections with absolute clarity, recognizing that headline chaos frequently misrepresents true intrinsic business values and overall long-term investment opportunity across diverse market sectors.
So, how should retail investors position their portfolios during August without making panic selling mistakes? First, defensive positioning does not mean liquidating everything to cash and sitting on the sidelines. Instead, focus on prudent portfolio maintenance. Check your target asset allocation. If high-performing tech stocks ballooned over the spring, rebalance gains back into index funds, defensive dividend stocks, or short-term high-yield cash cushions. Second, lean into dollar-cost averaging. Automated monthly contributions take human emotion out of the equation, allowing you to automatically buy quality assets at seasonal discounts. Maya keeps a modest emergency cash reserve, so she is never forced to sell stocks during a temporary market downturn to cover immediate expenses. When Jordan wants to hit the panic sell button during high volatility, Maya reminds him that market timing is a loser's game, whereas disciplined asset allocation protects wealth over the long haul. To sum it up, August does not have to eat your portfolio alive. Seasonality is simply a feature of auction markets, not a flaw. When low trading volume exaggerates market pullbacks, reactive investors sell at the bottom, while disciplined investors follow their systematic plan. Review your portfolio allocation. Keep your automated contributions running on schedule. Maintain a healthy cash buffer and ignore the hysterical sensationalism on financial news channels. Remember, real wealth is built by staying invested through market cycles, rather than trying to outsmart short-term seasonal weather. If you found this breakdown insightful, hit that like button, subscribe to FinScribble, and drop a comment below letting us know how you are positioning your portfolio for the second half of 2026. Keep your head cool, stay focused on your long-term wealth goals, and let the summer noise roll right off your back.
As always, appreciate you hanging out today. See you in the next one.